we're welcoming Gavin and Graham from AEC Group. They're going to be talking about better practice general rate reviews. Happy to take questions. There's a Q&A box. If you have any questions, enter them. We'll see how we go about answering them either during the presentation or at the end, or if we run out of time, then we'll look at trying to get something posted up on our members' website. So I'll hand over to Gavin and Graham.
Thank you. Good morning, everyone. As indicated, we're here to look at general rate reviews and look at best practice or better practice general rate reviews. We've done quite a few over the past 2 decades, and just give you some insight as to how we would undertake them, what things we would consider, what are potential issues you might come across, particularly in terms of revaluations, and in particular revaluations where individual sectors are primarily affected rather than across the board increases. So an overview, we'll look at the regulatory context. So obviously there's legislative provisions that you need to follow. There's guiding materials and also the recent findings of the QAO report. And also look at local considerations. What local factors should you take into account when looking at what categories are appropriate and what differentials are appropriate for each category? What is the high level review process that we would undertake in doing a general rate review? Rating effort, rating burden. So this is the extent to which you are extracting income from the economy and individuals and how that differs across localities. Benchmarking outcomes, so looking at your peers, what they're doing, and also where you sit in terms of rating levels. What should you consider when setting categories, differentials and minimums? We'll run through some options for each sector, so residential, non-residential, rural, multi-residential, large retail, large industry, etc. What to do during revaluations and how revaluations can actually impact the justifications for your categories over time. There can be a cumulative impact where in 5 years' time you might have a rating structure that looked nothing like the rating structure that you had in place in the first year. What we do in terms of impact modelling, so what information should you give your councillors to make an informed decision as to which ratepayers are impacted and how they're impacted. And then just a few case studies to look at some examples of what we've recently done and how the changes have gone from prior to the rating review and then after the rating review, and why. So the regulatory context and local considerations. Obviously, we've got the Local Government Act and regulation. So basically, general rates are there to fund goods and services that are provided to the community that are of broad benefit, not specific benefit, so that they can't be recouped via fees and charges or utility charges or special rates or the like. Levied on rateable land obviously can average value over 2 to 3 years as well. You can apply minimums. Councils actually in Queensland have the most discretion as to what they can decide a rating category is, and also what differential can be applied to each category. In other states, there's a lot of restrictions placed on councils in terms of which categories they can adopt and what multiple can apply to one category over another, sometimes even requires ministerial approval. And obviously differential rates can't be levied on the basis of the capacity to pay of individual owners or properties. However, you can take into account how the land can be used to generate income. So what is the capacity of the land, not the ratepayer, to generate income. Have to be careful in setting minimum rates as indicated by the Sunwater versus Burdekin case. So making sure that the minimums aren't out of kilter relative to land valuations. There's a Queensland Government guideline that was put out in 2017. Principle of equity, principle of user pays, meaningful contribution, so that's the minimum rate aspect. Predictability, so it doesn't jump up and down from one year to the next. And fairness. The QAO back in 2018 or 19, undertook a review of local government rates and charges, and their findings were that there's not much transparency across Queensland councils regarding the basis for the categories and differentials. They're just listed in the revenue statement with no explanation. They believe there should be greater transparency. So what are the justifications for a rating structure? They say that you should consider the benefits derived by different ratepayers in setting differentials, look at equity, taxation principles. Obviously, at the end of the day, general rates are a tax. What's the best way to levy that tax? They say there should be enhanced linkages between rating decisions and council financial sustainability, and also that there should be greater community involvement overall in budget setting and rate setting. Now, looking outside of the regulatory context, the local considerations, do customers or ratepayers understand the rating structure? That obviously feeds through to customer service inquiries you might get on rating issues. Non-strata multi-residential, so should you consider somewhere like Fraser Coast has a lot of development in the residential parks, over 50s, RV parks, how to rate them appropriately given that they're not strata titled. Short stay accommodation, are you being, if you're in a tourist area like Gold Coast, Noosa, Sunshine Coast, how to appropriately rate essentially what is a commercial land use within a residential ownership category. Urban versus rural service levels, or township by township service levels, how to take that into account. What is the composition of your local economy? What is a large or intensive industry that might place an impost on your infrastructure and service provision locally? What are other developments that are happening, renewable energy, either production or storage, and how to rate them appropriately? And the final one is economic and planning incentives. So the extent to which policy agendas are incorporated into rating structures. My personal preference is to not incorporate such things in the rating structure, but otherwise instead provide concessions or similar things or other incentives to ensure economic and planning outcomes are achieved. Our review process. So the first thing you look at in a council revenue strategy is, and this goes back to the benefit principle, that the general rate should only fund the things that your specific charges are not able to fund. So maximise your other sources of revenue first. So external grants, fees and charges, make sure that you're recovering overheads on fees and charges. Utilities, make sure the utilities, if they can, fund themselves and potentially provide a return to the general fund. Contract works, obviously you want to try to achieve a surplus from contract works to contribute to the general fund as well. Then you have a residual funding requirement after all of those revenue sources. What are special rates that potentially could apply? Example, for a CBD area, if there's a higher level of service, is that best funded through a special rate rather than the general rate and differential rates? Are there any separate rates, levies, such as disaster management, that should be in place to fund specific activities of local government that may not be considered normal core service? And then at the end of the day, you've got a dollar figure that you need to recover through general rates. And then we look at what's the best way to then distribute that rating burden across the economy and community through differential rates. So the review process at a very high level is to firstly look at your current structure, understand the current structure, look at the dollar contribution by category. So what sectors of the economy are contributing and the extent of those contributions. Look at the rating effort assessment. So essentially what that is, and it's discussed further in some slides that are upcoming, is what portion of household incomes are taken up by general rates. So an average general rate divided by average household income is one example. You can also do that through the non-res sector as well, the productive sectors of the economy, to see what contribution of their incomes is taken up by general rates. Confirm your rating objectives. So considering those local factors that I mentioned earlier, what is the outcome of the rating review process? What are you trying to achieve? And then look at issues and anomalies. So you might get that through customer queries, or some things, if you just eyeball the list of categories and differentials, might not make sense. And that could be a result of revaluations over time. So the last 5 years, there's been changes in revaluations across sectors that haven't been the same. We then look at benchmarking. So it does provide a good indication as to where you sit and what categories you are levying versus other councils, and whether there's trends occurring that some councils are introducing new rates for, say, wind and solar farms. Maybe if we potentially could have a wind or solar farm, maybe we should have a category in place ahead of time. So look at residential, commercial, large retail, so large shopping centres, intensive industry, so that's your large, heavy noxious industry, or ports or theme parks. Primary production as well, if applicable. Then we usually look at, okay, what options are there versus the status quo of making amendments to the rating structure. Have a workshop with stakeholders to discuss those potential options, shorten them down to realistic options that require consideration. Then you undertake the rate modelling and consider the impacts on ratepayers in terms of dollar value and percentage increases or decreases. Then go back and discuss the outcomes and obviously decision making thereafter. So that's a high level review process that we would go through. The rating effort burden. I'll throw over to Graham now to discuss this aspect of the review.
Yeah, morning all, and my thoughts out to those of you out there and isolating home and crooks. So I hope you get better. So in terms of the rating effort burden that we provide, I'll just go back. Just the context of it is those QA recommendations, and the rating effort burden calculations that we provide really hit those requirements the QAA raised around what's the basis upon which you're rating, and how you're differentiating, rather than just targeting the ratepayer, but the actual characteristic of the land or the earning capacity of the land. So that's what the rating effort does. So what we look at is we look at the local economy, we look at the different industries in the local economy, and we'll look at the household income down to by suburb level, and have a look at how much of that capacity to pay is the rate taking at the moment, and what's the potential going forward. So what we look at in the overall is take the total rate revenue as a percentage of the gross regional product. So that's a pretty high level assessment of the I guess the earning capacity of the community as a whole. But we split that up as residential. We look at the household income, and we look at what the average residential rate is as a proportion of the household income, or we might even swap that out for the disposable income. So removing all of the cost of living, what's the disposable income for that suburb, and obviously we wrap that up at a council level. When we're looking at the non-residential, so the productive sectors of the economy, we are looking at what's called the gross operating surplus. So I guess a unique offering that AEC provides is the ability to take that gross regional product and provide what's the gross operating surplus. And the gross operating surplus is more akin to the profitability of the industry, and therefore provides you a great basis upon which to make your assumptions on who has better capacity to pay than others. Thanks, Gav. Next slide. So AEC has done this over many years, and we've been able to, I guess, build a repository of that data. And from the benchmarking that we've done in the past, when you're looking at the total GRP of a council or local government area, the benchmark in terms of the total rating is usually about 1.4 to 1.9% of the gross regional product. So we're able to show you and benchmark where you're at compared to other councils. So it's good to keep that in mind, that the benchmark between 1.4 and 1.9. But then if you break, next slide, yep. So when we have done benchmarking in the past, and we'll look at the case studies a little bit later, and I'll explain a piece of work that I did down in Victoria to benchmark the councils down in Victoria. But generally the household income, again, is about that 1.5 to 1.7%. And we can look at it suburb by suburb, and you can show your councillors, you know, who's got the capacity and who's currently paying, potentially the capacity to increase in different areas, and obviously look at potentially areas to build, I guess, a more complex differentiation of your general rate. And as I said before, we can also convert that into disposable income to have a look at truly what's the capacity for the households to pay after they've paid their fixed cost. The non-residential rating effort. So this is just a busy screen, but it just shows you some of the level of detail that we go down to map your rating categories to the industries. And that's how we tally up what's the gross operating surplus for the industries, and then compare that to the total rate. So how much are you rating the rural space compared to the gross the gross operating surplus out of the rurals, and this is the tables that we use to map industries to your rating base. Back over to you, Jeff. Okay,
thanks, Graham. So after that, all of that data is generally publicly available, and you can undertake that. There's average residential rates that are published by the department in the comparative information statistics as well that can be used. That is essentially where this graph comes from. So ABS census, this is GRP, so that is available in the Ready, Set, Go as well. Household income's available through ABS, and the average residential rate is available through the comparative information statistics published by the Queensland Government. Now look at benchmarking. Basically, it's useful for scene setting, introduction to budget processes. Councillors are interested in where their particular council sits relative to peers. You select appropriate peers for benchmarking. It might differ by category. You might have normal peers, but they don't have the industry sector that you do, so you might need to extend beyond them to see who else has a mining sector, for example, or who else has a large quarry or port. Ensure apples versus apples. So whenever you benchmark general rates, you need to consider separate rates, because some councils have significant separate rates for what are core services, except for road network, environmental. Don't just focus on the rate in the dollar or minimums. Obviously, valuations will vary significantly by council area. So Noosa versus Toowoomba, for example, is going to be a lot different. And the benchmarking outcomes, as I mentioned, they're useful for scene setting, but they're not gospel. You do need to consider the local factors. So again, this is information from the department's comparative information statistics. We would benchmark general rates plus separate rates together, as mentioned. The average rate is about $1,180 across Queensland as a whole. So this is about up to 5 suburbs per council across all councils that provided the information to the state government. Obviously varies significantly from $100 odd up to nearly $3,000. Obviously that's going to be a coastal community. So it does vary. So you do need to be careful who you choose and what localities you choose in benchmarking. So looking at rating category trends, so looking at all the councils, all their different rating categories and rating structures and rating levels, what are the trends, what is being adopted out there. So obviously principal place of residence versus non-principal place of residence, so owner-occupier versus investor. For those that adopt the non-principal place of residence categories, they generally apply a premium of 20% to both the rate in the dollar and the minimum rate, so 20% higher. Rate banding is used quite often to reduce the impact of rates and the rating burden on higher value properties. So if you are beachfront and have a very, very high valuation, the cents in the dollar is generally reduced for those properties in certain areas. Urban versus non-urban and township versus township. So yeah, are there different service levels? They do vary though. So in some instances, urban might have a higher rate in the dollar, in some instances might have a lower because their valuations will be different from non-urban and rural. Strata units. So strata units, their average valuations are a lot lower than residential dwellings. However, they still contain a household that utilise all of council's infrastructure and services. So do you levy higher rates in the dollar on strata units? Generally, yes, when they're adopted as a separate category. Non-strata multi-residential, so flats, residential parks, retirement villages, generally levied higher rates in the dollar, and in a lot of instances, a minimum rate per resident. So they might be grouped in 2 to 4, 5 to 9, and the 5 to 9 flats category might get 5 minimum rates, so the equivalent of 5 residential minimum rates. Short stay accommodation in tourist areas, relatively new concept. Generally a premium of 50 to 100% is applied, so it essentially brings them up to a commercial rate rather than a residential rate. For commercial industrial, generally set rates in the dollar are set higher, and even minimum rates are set higher than residential, on the basis that it's generally a greater intensity of use and intensity of activity at commercial sites relative to residential sites, so traffic and the like. Urban versus non-urban exists as well as per residential, and in some instances you have special rates for certain localities such as CBDs. Rate banding again exists in certain areas, and there's an increasing alignment between commercial and light industrial. Historically, there used to be a lot of commercial categories and industrial categories that they've kind of come together, and there's not a lot of difference between the rates and the dollar set for those categories. Now, looking at the specific commercial industrial, so the more intensive uses, extractive industries, so quarries, they are subject to higher rates in the dollar again because of the activity being more extensive than a normal commercial use. And the minimums, it's good to compare minimums if you're doing benchmarking based on what the tonnage categories are, and bringing that back to $1 per tonne rate. So even though you can't charge them per tonne, you can compare your minimums to other councils based on their equivalent per tonne rates, and 15 to 20 cents per tonne is kind of what comes out of that benchmarking. Resources sector, obviously subject to higher rates in the dollar minimums. There's a lot of different approaches to, I guess, categorising and then setting minimums based on employees, land area, etc. The per employee is declining, the use of that, given there's increasing automation in the sector, so the employee numbers are actually reducing. For those still using employees, it's about $300 to $400 per employee is where the minimum rates kind of fall, and $2 to $5 per hectare for those using land area. For other major industry, there's obviously higher rates in the dollars and minimums, and those should be set with reference to local factors and what impacts they have on council infrastructure and services. For worker camps similar to non-strata multi-residential, in that the minimums and categories are generally based on rooms, and based on the benchmarking, about $400 to $450 per room, or equal to about 55 to 60% of the residential minimum rate per room. And renewable power generation, which has seen an increasing number of categories across Queensland. our benchmarking suggests that it's $200 to $500 per megawatt when you group them in megawatt categories. And it's important to note that Victorian councils actually get more than $1,200 per megawatt from their renewable power generators. So we're still pretty low compared to them. For large retail, obviously that historically has been shopping centres and drive-in shopping centres. Retail warehouses, the distinction between retail warehouses and shopping centres now is again, just like the commercial industrial, it's coming together. You would generally try to incorporate both shopping centres and retail warehouses as one category called large retail, and you'd group them in square metre, gross floor space area categories. There's an increasing scale of rates in the dollar and minimums to reflect increasing intensity of activity. And recent study we did, just benchmarking, say there's one residential minimum rate per 100 square metres of GFA for centres that are quite large, beyond 10,000 square metres. Primary production, the valuations are often more consistent across council boundaries. So you can actually benchmark rates in the dollars to provide a good comparison. A few councils differentiate based on grazing versus horticulture versus intensive animal activities. And where there's intensive animal activities, again, there might be different categories based on production capacity targets or groupings. So 0 to 1,000 head of cattle, 1,000 to 2,000, etc. And they'll have increasing rates in the dollar and minimums. It's all about the impact on particularly the road network. The larger it is, the more impact it is on council's infrastructure. So setting categories, differentials and minimums. The overall requirement for differential rates is, I guess, to overcome deficiencies in the method of having unimproved and site land valuations as the basis for determining wealth and the income generating capacity of land. In other states, they do also have improved valuations. So you do actually, if you have a multi-residential block of 20 flats, it's going to be valued higher than just a household. So you don't really need to have the structures in place that Queensland does because it's an unimproved or site land valuation approach. So that's the reason why we need differentials. Now, then you need to go, okay, how many differentials do we need? What categories? Who should pay more? Who should pay less? You look at location, access to infrastructure, geographical constraints to accessing services, land use, driver of demand and costs on councils, utilisation of infrastructure and services, derived benefits. I'll have a quick look at that in the next slide. And relative valuations, to what extent should that reflect wealth? And I guess that's the rate banding approach. There might be those that are asset rich but cash poor. So their capacity to pay isn't necessarily higher just because they have a higher valuation. You have to weigh up simplicity versus complexity to achieve equity. Simplicity won't generally result in equity. Complexity will generally result in more equity. However, you do need to balance those to ensure there is community transparency and understanding of the rating structure. What level should form part of the minimums? What base common services do you think should be recouped through the minimum from every property? What's the role of separate and special rates and levies, as indicated before? And also be forward-looking. Look at what might happen in the future and what might we need in our rating structure to deal with that. While we might have a shopping centre of 20,000 square metres now, is it going to be 40,000 in 5 years' time? How are we going to deal with that in our rating structure? While we might have categories to deal with blocks of flats up to 20, we might have a residential park coming in that has 150 non-strata residences. How are we going to deal with that? The derived benefits argument. So this is the extent to which each sector utilises council's infrastructure and services, and obviously general rates are a tax, so it's not all about user pays, because what we're looking at are goods and services that are of common benefit. However, there are certain aspects that some sectors utilise more than others. Just done a very, very high level example here. So council overheads, administration, planning, pretty much everyone benefits from that equally. However, when you look at roads and transport, commercial, there's greater intensity, intensive industry, there's greater intensity. Rural, maybe not greater intensity. However, obviously the length of road per property is a lot higher for a rural area than residential area due to the size of the blocks. And parks, greater use by residential, not so much the other categories. Reg services and environmental health, the commercial, industrial has a higher weighting allocated there. Community facilities, community services, again, residential highest. Now, if you did all that, if you ran your OPEX, including depreciation, did these percentage allocations across sectors, do the sum products, and it comes out to be, so residential is the base of 100, commercial, okay, maybe commercial should be 1.6 times residential. In intensive industry, maybe it should be 4 times residential. Rural, maybe it's only 0.9 of residential. And this is just an example exercise. It's not gospel here either. It's just to show you that this is one way you can look at derived benefits. So residential, as mentioned, a lot of this will be from the benchmarking exercise and the outcomes that I've already gone through. What are the things you might want to look at? Okay, how do we set minimum rates? What's the affordability for low income earners if we set it too high, and balance those two out? Principal place of residence versus non-principal place of residence. Are you going to apply it? And then if you are, on what basis do you set the premium? As I mentioned, 20% is the benchmark that we've looked at for those that actually apply. Do you think rate banding is a good idea based on the distribution evaluations? And then if you are doing that, what's the reduction in the rate in the dollar for higher value bands? So if it's 0 to 250,000, 250 to 500,000, 500 to $1 million. If it's, you might want to say 250 to 500,000. Okay, let's set the rate in the dollar 5% lower. 500,000 to $1 million. Let's set it 10% lower. Have some sort of basis for that structure, and maintain that basis through revaluations as well. Urban versus rural, township versus township. Consider whether urban versus rural valuations already reflect the access to infrastructure and services. And if so, maybe the rate in the dollar is fine to be the same, but you then play around with the minimum. Maybe the rural has a lower minimum. Is there large rural residential? Should they be levied higher rates or lower rates in the dollar? Strata units versus strata dwellings. Do you have a lot of strata units? Are they valued significantly lower than strata dwellings? If so, should you have a separate category and a higher rate in the dollar? Short stay accommodation, is that an impact for your area? If so, what is the premium to apply? Should you apply a commercial rate to them? Because it is essentially a commercial use. Multi-residential, if you look at multi-residential, if you want to separate multi-residential, so this is the non-strata blocks of flats, units, duplexes, residential parks, retirement, RV, home parks, etc. What's the definition? You need to be pretty clear as to what the definition of this category is. How are you going to ensure equity between strata residential properties and non-strata residential properties? One way is to look at bands of residences to apply minimum rates to, so 2 to 4, 5 to 9, 10 to 14, 20 plus, etc. There's some councils that have 250 plus, so that they actually have, Moreton Bay actually has a category for every single one. So it's 2, 3, 4, 5, 6, 7, 8, 9 in terms of flats, and then they also do that for retirement homes as well. Then the minimum rate equivalence. So at the 5 to 9 category, do you apply 5 full minimum rates? Do you apply 5 half residential minimum rates? It's just deciding upon what level of equity you think should be applied to strata versus non-strata. And at the end of the day, what's the degree of complexity, number of categories you want to apply? As I mentioned, Moreton Bay has hundreds of categories. Others might only have 5, 10, 15. Just depends how many you have what size they are, and then what's the weighing up of equity versus simplicity that you want to achieve. For commercial industrial, what's the relativity of the rates in the dollar and minimums you want to apply to them relative to residential, and on what basis? Urban versus rural, township versus township, as mentioned, rate banding as per residential as well. Commercial light industrial, are they one and the same? Should you consolidate to just one category? What major industries do you have? What are the basis for the rates in the dollar and minimums? I went through some earlier from the benchmarking exercises. Renewable and electricity generation and storage. What's the basis for categorisation and minimums for them as well? For rural, what's the relativity to commercial? They're not necessarily as high in intensive use. They might be during certain parts of the year, but not consistently. They've also got potentially reduced benefits derived from council infrastructure outside of roads. So that's another thing to consider. Is one category sufficient? What do the rural valuations reflect? Are differentials already reflected in valuations? Do you have intensive animal industry? What minimum rates do you want to set for them based on throughput capacity? I'll just move on to revaluations. How to deal with revaluations, particularly significant revaluations. Often when you do rating reviews, you see you could ask a council what's the basis for the differential rate applied to this category versus this category, because it doesn't make sense. So the use of rate banding is to apply a lower rate in the dollar for higher valuation properties. In one instance, we've had higher valuation properties subject to a higher rate in the dollar relative to lower valuation properties, just because the revaluations had been put through at a category level, and those in the lower value properties had just through the calculations had over time increased the rate in the dollar more than those in the high value properties. So there was no basis or justification for that rate in the dollar being where it was. So over time, the revaluations can distort where categories sit relative to where the principles may have been applied initially. It's essential that those principles be maintained over time and as a result of revaluations. If you adopt a multiple base rating structure, so commercial should be, I've got here 1.75 times the residential category for non-res category 1. Even after revaluations, make sure that relativity exists. So all you have to change essentially is the residential category, base residential category, and all the other rates in the dollars will flow through. So this has the issue with just simply applying the multiple approach is that there will be times where there has been a significant structural shift in valuations, relative valuations. This occurred with primary production a few years ago, and some councils got caught out where they went up 50 to 100%, and simply putting through the impacts without even looking at the relativities between the different categories meant that rate increases for primary production were massive compared to other sectors. So you do need to consider where there's structural shifts, then those multiples probably do need to change. This will happen for residential land in the current year, which will probably go up by up to 50% over the past 18 months. So you do need to look at rebalancing the rates in the dollars and the multiples. So it's instead of commercials being 1.5 to 2 times residential rates, which is where the current benchmarking sits, they might need to actually increase to 2.5 times to retain equity and to ensure that residentials don't have increases in rates and other sectors decreases in rates as a result of this current or the recent structural shift in the valuations for residential relative to all other sectors. So quickly look at impact modelling. What do councillors want to see? Nearly there, we're nearly at the end. It's extremely important for councils to know exactly what they're signing off on when they're They're looking at what rates are being implemented, whether it be as a result of reevaluations or as a result of a fresh rating review. You need to present the impact modelling in easy to understand format. So what's the impact on the residential ratepayer? Obviously, maybe across different localities if there's significantly different rates across localities. Distribution of impacts based on dollar change and percentage change. So how many are affected and to what extent. And then look at the very high value impacts. So what specific ratepayers are significantly impacted. So just an example, and this presentation will be available after this, so you can just have a look if you're interested in doing something like this yourself. Look at the general rating categories by type of ratepayer. What's the proposed rates, current rates, dollar change, percentage change? That's in aggregate across each category. And then to the right, the impact distribution by extent of impact, so 0 to 5, 5 to 10, up to greater than 50%. But it's also good to understand dollar value distributions as well. A 10% impact might actually be $25,000. So you do want to know what the impact is, both in percentage and dollar terms. So I'll quickly run through some case studies. I won't go into too much detail. Again, this will be available. NUSA recently, this financial year, introduced new rating structure. The objectives consolidate a previous separate charge or levy into the rating structure. Look at the rating of short stay accommodation, given that significant impact for NUSA Council, and other amendments to increase equity and fairness. So basically the rates were increased to recoup the previous funds collected through the Tourism and Economic Development Levy. Residential was unchanged given that there was an upcoming valuation this year, so they'll need to do that for next year. Residential categories were expanded to include and separate transitory accommodation, so your short stays. Non-strata multi-residential categories were expanded for greater equity. Non-residential categories were consolidated into a single category. Shopping centre categories, again, based on floor space thresholds, were expanded. And greater than 40,000 was introduced, given that there are potential expansions to current shopping centres. Extractive industries rates was increased based on an assessment of actual cost to service that property. Townsville, the objectives were no impediment to CBD activation, fair and equitable, simpler. So as a result of the review, there was fewer categories at the end of the day. There was alignment of commercial light industrial, as occurred with the NUSA one. Removal of inner city rating premium, so they had a rating premium on CBD area, which was removed. And alignment of retail rate categories in terms of, there was previously your large format retail versus shopping centres, and they were aligned into the single category. Fraser Coast, actually as a result of the fair and equitable objective, it actually required an increase in number of rating categories. This is where the simplicity versus equity issue comes into place. They split into urban and non-urban, alignment of vacant land rates, consolidation of commercial industrial again, and removal of the CBD premium in Maryborough, and additional multi-res categories given that they have significant development in that area of residential parks and Harvey Home Parks and the like. Okay, Graham, I'll quickly hand over to you for this.
Yeah, thanks, Gav. Yeah, just quickly, work we did down in Victoria with large movement in land valuations and with the requirement for rate setting, and some of the interesting observations around the differences in the rating effort by different rural councils, and which just goes to show there wasn't too much reason behind the way, or the reasons for the way that they were setting their ad valorem component, the rate in dollar. The next case study was one that targeted gas plants. Gav, if you can just move to the next slide. interesting sort of observations around this one was the huge difference in the way that gas plants are rated by different respective councils, and just a very interesting perspective when you look at the gross operating surplus of those industries and the different rate burden. We're talking very significant differences in what some councils were rating gas plants compared to others. So yeah, very interesting to look at this sort of benchmarking and just to see how your rating of particular industries are compared to others. Back to you.
I'll just stop the share because we have come to the end of the presentation, so I'll just try and answer some questions if there are any.
Yeah, I've been jumping in there, Gav, answering some questions. Yep. So I've been sort of answering along the way.
Does anyone else have any queries?
Yeah, Gavin, just a point. Sorry, it's Tony. Hang on, where am I? In regards to where we had this slide where you've got the where you were looking at working out the percentage, like your relativity for your rates between the commercial and residential and that. Do you have any thoughts on determining minimum rates? Like say if your residential minimum rate is 1, or your base rate, and then it might be 160% of that for commercial or whatever. Any thoughts on sort of how you would go about setting up that minimum rate?
Yeah, so a normal shop, like a small shop, generally won't have a large impost on your infrastructure and service provision. So in most cases, the commercial minimum rate is set at a level pretty comparable to the residential, and you let the valuations do the work. So if you have a higher rate in the dollar for commercial premises, the minimum rate is less important. There'll be a lot less properties on the minimum rate. Should be no less than residential. If you are applying, what I will say is if you're applying a non-principal place of residence category, your commercial rate shouldn't be any less than that. So if you are applying a 20% premium on non-principal place of residence, then you should apply a 20% premium on the minimum rate for commercial. That's for general commercial though, as I indicated, where you have commercial uses that do have high intensity and activity, they should be subject to significantly higher general rates, whether it be both rates and the dollar and minimum rates.
And I guess though, what numbers feed into the deriving of your minimum general rate? Is it you exclude your parks, or you are just your admin, your base factors? Like I think the department have recently worked out that it costs about $10 million to run a minimal, like the minimum cost of running accounts was about $10 million across the board, which seems to bear out when they're looking at their sustainability changes they're looking at. So is that a good basis of working out what a potential minimum rate could be, or is there something else in your experience you might have seen? Yeah,
look, in practice, there's not a lot of science behind where the minimum rates are set. You do obviously want to weigh up the affordability issue. So if you have say 20% of your community that are really low income, or you do need to take them into account in terms of where you're setting your minimum rate, not just looking at cost to serve, base basket of goods type approach. I guess it's a mix of both.
Yeah, I did one recently where we tried to do that approach, Tony. And and it ended up being, we tried to estimate what the fixed, I guess, services that everybody consumes to reflect that as the minimum. That was what the council wanted to have a look at, and it was just significantly more than what the minimum currently was. So it was an interesting exercise to do, but at the end of the day, it was not practical to use it because the minimums would have had to have increased significantly, and obviously the higher valued properties benefit out of that, and so they didn't want to go that way.
Yeah, I guess it's like your water charges, your fixed costs there are 90% of your cost, but everyone's set the charges at, say, a 60-40 split. So you do have a variable component.
We did also use just a differential percentage on generally what, compared to residential, what the different rating categories consumed of councils' services, just to justify, I guess, the differential in the minimums, but it didn't define the amount of the minimum. It just justified that business, commercial consumed 230% of services compared to residential because of because of their consumption on the assets and infrastructure. So there's some reasoning behind why there's a differential in the minimum, but not the actual amount on the minimum. Yep.
I've got a question here about how many Queensland councils have non-principal place of residence. Probably looking just at the large councils, so say about 18, I'd probably say there's 8. So there's probably just less than 50% of those types of councils. But I know a lot of the smaller councils, rural regional councils, don't have those categories. So it is generally your larger councils that do apply them. Benchmark of how many people should be on the minimum. Not really. I haven't got that figure, but what I would say is that preferably you don't want the majority on it. I know there's some councils that have over 60% on the minimum. So I would suggest that not the majority, so preferably less than 50%. And Kim, yes, most councils do use land use codes as the basis for selecting rating categories. However, land use codes alone will not facilitate some of the categorisation that you do need to put in place. So you do need some other identifiers and descriptions in certain instances.
Yeah, there was a question earlier in regard to principal place of residence. Jason asked it, and I just responded to that one. In my experience in working in the rating area, I mean, it's one of those ones that you need to maintain yourself through making the ratepayer meet criteria to be eligible for the discounted PPR. There's no magical box out there that's going to enable you to identify all the properties that are principal place of residence.
Yeah, and regarding the short stay accommodation, for those wanting to know how you can identify those properties, Graham, you've recently used one of those.
Yeah, there's a provider. I don't know if I'm allowed to say on this, but there is a provider out there. You can talk to me later if you want, that we have referred to a couple of times, and they do a surfing of all of the all the sites that short-term accommodation is advertised on, and they'll give you a monthly update on the properties that are being advertised in your area on short-term accommodation. So if anyone's interested, just get in contact with me and I'm happy to refer you on.
And that's an answer to the question that we that we just got.
Yeah. Just with that one too, it's you need to work with your local laws. It's very difficult to enforce. We did some advice for council down in Victoria on this as well, and they don't have local law support for the category. and therefore it's very difficult to force people to register. And then you've got to do, you know, your surfing and searching for for properties being advertised. But if you've got local laws supporting it and you're required to register, and then there's a penalty if you don't register, that's how you can maintain a more accurate database of properties being used for short-term accommodation.
Yeah, regarding principal place of residence, people can try to get around it so that their mail still goes to the property, but there are other ways. I'm not that up to speed with what occurs, but there are ways that councils are looking at that, not just looking at postal address.
Yeah, there are some again providers that'll help you with updating your NAR or your address register to do those sort of checks. But most councils are relying on a stat declaration for, you know, if they're using it more than 60% of, so usually you force, but it's pretty soft to enforce that. But yeah, most councils I see use a stat declaration, require the ratepayer to make a stat deck that it is their principal place of residence.
Okay. Well, we might wrap that up there. There's certainly a lot in that, and it's something that obviously councils are starting to launch into now, and thinking about this year's rates, or they're thinking a little bit further ahead in terms of their strategy. So it certainly, I guess, has probably raised a few more questions than for people will think about over the next little while. And one of the things that we could look at is with our member connect, member network, email threads and those sorts of things. We could look at maybe starting something up. So there was a question there about a further, just like a discussion forum, I guess, amongst members. So that's something we could probably have a look at if somebody's willing to facilitate that, and then yeah, we can put something out through our emails to the members on that. There will be a copy of this video on YouTube in a little bit, and also a copy of the presentation will go up on our members portal. So if you haven't logged in to that as yet, that's on our LGFP website, so you should be able to get into that. I will be on the 24th of February. We had a planning session the other day just to start to finalise what our webinar series are for the year. So we'll be releasing the details of that pretty soon, once we can start to make sure that the presenters are actually available. So, but the 24th will be our next session. So thank you very much, Graham and Gavin. We've got a survey will come out at the end of the webinar for people to provide feedback. We're always very interested in that feedback, and if there's any other questions, I'm sure you can catch up with Gavin and Graham privately later. So thank you all for attending, and we'll see you next time.